Hello, this is Justin Paolini from Building a Trader. Welcome to today's webinar called Focusing on High Quality Setups and Triggers. Before we start, let me just go through the risk warning. Trading foreign exchange carries a high level of risk and may not be suitable for all investors. The high degree of leverage available can magnify profits as well as losses. You can lose more than your initial deposit. So before trading, please carefully consider the risks and the interim costs and seek independent advice as required. Please contact us to discuss any questions or concerns you may have because we are here to help. And with that said and done, let's get into today's session on high quality setups and triggers. I've decided to do this last webinar of 2020 on this setups and triggers because recently a lot of questions have come up in the Building a Trader members area with a bit of imprecision or confusion or just complications regarding setups and triggers. And so I wanted to give a few pointers that have really helped me in my own trading to try and just clear things up. This webinar is made up of two parts. This first part is going to be free for everyone, even non-members, and I will be posting this on YouTube. The second part will just be for Building a Trader members. So if you see this webinar at a certain point being cut and you're watching the recording, you know why. So let's get into the details. What kind of skills do you need in order to craft good entries? What I've noticed throughout the years is that as much as we'd like to have these beautiful objectives or whatnot, trading is about scalping, essentially. It's all about short-term management and short-term entries at the beginning, and then only if price demonstrates that it wants to progress and it wants to morph into something more can we actually think of a multi-day trade or a longer-term trade. So the first thing to really understand is that trading is timing, and timing requires skills. So what are the main skills I use to help my timing? We can call it tape reading. Now, there's a lot has been said about tape reading, and to keep things as simple as possible, tape reading is basically just monitoring the current price action and asking yourself, is price going up or down right now? However, we're not just wondering if price is going up or down randomly. Okay, we need some reference points in order to measure, in a systematic way, what price is actually doing. So these reference points, many Building a Trader members will know them, but they've also been disseminated on the net by traders like Linda Rashke and other market wizards, because certain things that have worked for decades still work today. And so yes, focusing on the days open, the weeks open, or swing highs and lows or round numbers, these are important points that various participants focus on each day and week in the market, and they can really help you zoom in on the right information because you can visually see if price is moving further away from one of these points or closer to one of these points. Okay, and that's actually the first question you want to ask. Is the market moving closer to, so is it pulling back towards, or is it moving further away, so is it trending further away from one of these particular points? And then you ask yourself, how fast? So with what kind of momentum? How far? Is it within normal measurements or is it extended? And in which direction? These are all, this is the first point of call, because sometimes, for example, the market will still remain in a trend if you look at it from a daily perspective or even a 4-hour perspective, but compared to yesterday's New York session, for example, you see the market completely reversing during Asia with stronger momentum, so coming back down with a stronger impetus, and that tells you something. Okay, that's a piece of information that's short-term in nature, but it really helps you understand the odds of having, for example, a long or short trade at that moment in time. And the second thing is, you need to anticipate the market's response to this particular situation. Okay, so if there's a trending market, for example, you'd expect the market to resume a trend after the pullback. Okay, you'd expect the pullbacks to be rather shallow. You'd expect the market to accelerate after a volatility contraction. You'd expect the market to rally on good news. Okay, these are all examples of realistic expectations that you can have. And when you see this kind of situation setting up, just observe what price is doing and ask yourself, is it showing me the common response I'm expecting? Because if it's not, you have a failure. And when the market fails to do what it should be doing, that's an equally strong signal. It's an equally strong piece of information. So now, a chart is worth 1,000 words. So let's go back to some examples that I wanted to show you last week, because this was this dollar CAD chart had come up in conversation with some of the members in the room, and so I just wanted to discuss. I wanted to repeat what I showed the member, because I think it can, it can really put some, what's the right word? I can really sort of illustrate this point in practice. So dollar CAD is evidently trending down. Okay, and so we're looking for key levels, and we're looking for a reaction to key levels. Okay, what you want to see, excuse me, just gonna have a sip of tea. Okay, so what you want to see at the given level is an unusual impulse of action. Okay, so basically you want price to hit a level, and you want to see it reverse with equal or incremental strength to the strength that took it up there, because it's a question of short-term momentum. Okay, and we'll see this when we zoom in. You will see it on different time frames in different ways. Okay, but the concept is that if the market is going to respond to the level you've identified, then you will see the market shift its momentum, and it will turn around with equal strength, or with even stronger impetus than the impetus that took it up there. Okay, so now we'll go and see this. What I've highlighted here were the key levels that that we were discussing with the member. And essentially on the Monday, so this is into the Monday here. On the Monday, the key levels that were in focus were the prior week's open, which was pretty close to this little consolidation zone up here. Okay, so price didn't get up there when it retraced. But one piece of information that the market left us was that the departure from prior week lows, current week's open. Okay, and remember that's a key level. The current week's open is a key level. Was rather strong. Okay, this departure was rather strong. So there was buying pressure there. So when the market comes back down to that level, okay, and I don't mean pip perfect. A lot of traders get caught with this demand supply kind of rationale where they've been taught that a certain configuration at a certain level, you place a limit order there, and the market is expected to do something or whatever. I've never been able to trade profitably like that. I've tried, of course. I've studied it, and in conversations with professional traders, they didn't outright dismiss it. What they said was that, yeah, maybe it worked for some people, but limit orders can be just trampled over. Okay, limit orders can just be taken, and the market can continue, because from one day to the next, the fundamentals may not have changed. Okay, so whatever caused the buying here might still be around when the market gets back down there. But that can change. Number one, that can change if a piece of news or a development or something happens intraday, and whatever orders were around here for whatever reason make no more sense, and the market can just plop right through. So the second thing is that the further out you go in time, the less relevance that precise order flow dynamic has. So what the professionals that I've been in touch with told me when I was lamenting my lack of consistency with this approach is that they just prefer to see a bit of intent. They prefer to see the market prove that it actually wants to stop there and turn around. And that can be on the 5-minute, on the 50-minute. It doesn't really matter, because the market will start to turn on the smaller time frames, and then you'll see it on the larger time frames as well. So depending on your objectives, you can decide to use the time frame that you're most comfortable with. But so anyway, that's what I'm just saying. This is counter trend, but there is a reason to look at that level if you want to play it, and at least you know that if for some reason you were able to get in short, then that's a level to watch, because that's where buyers could come in. And we'll go and see that. But what I want you to pay attention to is the levels that are formed in line with the trend. So now we have a Monday's high. Monday's high showed a bit of rejection, okay? And it's a key level. It's a prior day high key level. It showed a bit of rejection because price came all the way back down to Monday's lows from that point. So when price gets back up there, that's where we're looking for some kind of reaction, some kind of rejection. Okay, it's fairly simple. You have a swing point that shoved price down, and this is where we would look for that unusual impulsive action. And then once again, when the market, and then we know that the previous day's low again showed a decent reaction. So that's again the level that we would have to sort of take off that, and there will be contrary orders waiting there, most likely. And then we would look for the same kind of reaction at the highs once again, and that's and this is basically the cornerstone of my way of trading. And I just I had the key levels in mind, and I watched the reaction. I've highlighted this red line here, this level here, because this was another level that came up in conversation. This is more like a demand supply kind of thing. And I'll show you the difference in the reaction. I'll show you the different reactions from this kind of level versus these kind of levels up here. So you knew that you had to pay attention to the Monday low, okay, which is the green line. And keep this in mind. You're looking for unusual impulsive action. And to train your eyes, you just need to observe the way price trades at or around these levels. So price comes down with momentum into the level, stalls, but remember this stalling action here, even if buyers are appearing, compare the momentum. And so when I say momentum, essentially it's the size of the candles. So you compare the size of the candles on the way down to the size of the candles here, and you notice that downwards momentum is still stronger. This is also one of the reasons why I don't really like why this is still like picking a bottom, because you have you formed a little bit of like an intraday bottom here, but it's so easy for the market to try and push down again, and that's why a lot of the kind of entries that will give you the higher opportunities, the higher odds opportunities, are failures. So double bottoms, double tops, or a lower low with a divergence, and that's what you'll see very, very often. And so what the divergence means essentially is that the market pushed harder to get here than it did to get from here to here. So even though you have a lower low, momentum is actually weakening, okay, which means the buyers are starting to get the upper hand. It's an initial signal. Momentum shifts before price, technically, theoretically speaking. So how do you prepare yourself for this kind of opportunity? You need a level, okay, so you have a key level that you're focusing on, and all you need is for the market to come down through the level, okay, not pip perfect at the level. Remember, especially with foreign exchange, you need to give it a bit of leeway, because there is no central clearing hub for foreign exchange. Each broker will have slightly different pricing. So it has to come down through the level, and it makes a low. And what you're waiting for is for the market to make a lower low, okay, with an oscillator making a higher low. Okay, so you know exactly what to wait for. You've got to post a low close to the level, and then what you're waiting for is you're waiting for the market to post a lower low. and to see what the oscillator does. So, that's the divergence. Then you get the bullish reaction, and notice how this bullish reaction here, this is a 5-minute chart, this bullish reaction here is stronger, the candle size is larger than this bearish action on the way down. So you have two pieces of information saying that the thing is turning. Whether you want to engage, from there, or whether you want to wait for the market to actually, show a bit more bullish behavior and get in through the break of this previous swing high, it doesn't matter. The important thing is that you're observing how the market is trading in the here and now, and you're reacting appropriately. Okay, so that's the kind of thing. Let's see another example. This is when the market actually retraced up to Monday's highs. Okay, and what you see here is that there really is, when it gets up there, number one, it does not form any divergences. Okay, and the bullish behavior actually remains stronger, all the way through into the New York close, basically. So in this case, there's no use forcing it. There is no strong rejection. Okay, there's no strong action there. So there would be no trade. So now we have to go back to the lows, because the market eventually trickled down all the way back to Monday and Tuesday lows, which is still the green line. And what are we noticing? Now, when we got down there, as it usually happens, we had a piece of news. So the market goes back down, hits the level, on the Bank of Canada. But once again, what do we see? We had posted a low, and the market rallied, and then the market posted a lower low, okay, with no other lows in between. Okay, so it's very close together. There's not too much trading in between. The market posts a lower low, but the oscillator posts a higher low right after the news as well. These are usually great opportunities because you get a ton of people selling into the Bank of Canada, even though there was no surprise. Trust me when I say this. I know it happened a couple of weeks ago now, but there was no surprise. The Bank of Canada didn't do anything that wasn't already discounted into the price, which means that breakouts aren't really the right stance, because there was no real reason to shove prices either way. And so the continued range and doing a bit of back and forth, getting the other players stops is the higher odds thing. So you're at the level, you get the divergence, and bam, this first bullish candle here is enough to sort of scare the bears, because it's bigger than the resulting price action on the way down. So whether you get in on the break, for example, on the break of the high of that bullish candle, that is, or whether you want to play the break of this sort of consolidation here, so through here, doesn't matter. It's only a matter of a few pips, no big deal, and the market goes all the way back up. So once again, it's the same thing. You get a level, you focus on the action at the level, and you're waiting for a unusual impulsive action. Now here I'm going to show you the difference between those levels where the market actually trades into it, prints a bit of structure, and then prints like a fake out or a failed test or something, and instead those demand supply kind of things, which was the red line. I've noticed through experience that these demand supply levels, the people have become, a lot of retail traders have become super proficient at spotting, don't give you the same reaction. These levels, for some reason, maybe just for the amount of traders exploiting the dynamic, they don't turn around. Like, the market gets up there, and you can see that it boosts straight down without printing any structure. This is a 5-minute chart. The only piece of information it gives you is that it's stalling the inside candle, and then it breaks the inside candle. So it's, it's higher, to me, it's higher risk, because you do have to place a limit order, basically, if you want to try and catch these opportunities. Different way of playing. The other thing is that in trade management, I've noticed that it really pays to just follow the momentum and don't wait for any structure. It's like, it's a free ride. It's like if you can catch a free ride off of that level, then just maximize the momentum you're getting off of it. And you can, and if you're interested in trading this way, then I can help you structure your trade management if you want to work together. That's what I'm here for. So, so yeah, there's just a different dynamic that plays out at these demand supply levels. So, this is the other thing that we have to discuss. Trading is timing. Okay, trading is essentially market timing, and timing rhymes with objectives. Okay, you need to know exactly what you're looking for, exactly what your objectives are before you get into a trade. And actually, you need to know what your objectives are when you structure your trading system from the start. Because in my experience, traders will just screw up everything if they try to trade intraday sometimes, multi-day other times, swing other times, or if they try and change their stance each time. That's not what will allow you to become a profitable or consistent trader. Okay, you need to have objectives that are set out when you're creating your trading system. Here's an example to explain what I mean. So with one of our members, there's a bit of frustration because the member was trading here. He says, we're in a strong uptrend. This is CAD yen a couple of weeks ago. You will see if you go back onto a 4-hour or daily chart, you'll see we were in a strong uptrend. Okay, and he was trading here. Okay, so he's trading essentially this kind of intraday pullback, and he's saying, well, the market is strongly trending. Why can't I just enter here and hold it and see what happens? So the thing is, his preparation in saying CAD yen is strongly trending and saying, it's trending on multiple time frames. So I've got confluence, whatever. The thing is, he then places his stop loss just below this intraday swing low. Okay. And once he got stopped out after the Bank of Canada here, he was frustrated. And then the next day he's saying, look, I got in, I got stopped out, and then the market went in my favor anyway. So, this is frustrating because I was right. Is that true? Okay, is this thought process correct? Okay, so I'll recap the thought process. I'm getting in here. We're in an uptrend, so the market is in an uptrend, and I agree with that. I'm getting in here, and because it was, everything is trending nicely, and I expect the market to continue and and just move on. And then when I see this, when the market goes against me and I get stopped out and the market then rallies, I can be frustrated because I was right. In reality, I hope you guessed it, that's wrong reasoning. Because wherever you put your stop loss is where you decide you're wrong. So entering a trade here, okay, with a stop loss down here, means that you're essentially looking for a quick intraday move to the upside, because the stop loss just doesn't give the market space to move around, to wiggle. And anybody will tell you that unless the market has been stimulated by a big piece of news or a shift in sentiment, or I don't know, Biden or somebody else saying something, it won't shoot up in a uniform fashion and continue like that. It'll move around, and especially after a central bank meeting that just didn't do anything, the market will go fishing for stops. So that kind of reasoning, trying to enter here with this kind of with these parameters and saying, oh look, I got stopped, but then it went to my favor. No, you're wrong. The market stopped you out because you were intraday in terms of objectives. This is a multi-day objective, and the market may have done something else anyway. It might have stopped you out and continue going down. And then you would have said, well, at least I got stopped out at the right place and I didn't get that big decline. So in reality, saying this is mixing objectives and is not looking at things properly. So let's see the next slide. So here is, the proper expectation that I would have trading in that situation. Okay, if I'm trading this kind of intraday pullback, then I have to be aware of the fact that the continuation point, the point where everybody sees the market continuing, right, like the breakout point, is or should be my immediate target. So if I'm getting in around 81.45 here, then 81.55 is basically my main target for this trade, and my stop is 81.40, 81.38 with the spread. So I'm looking at a 1-to-1, just over a 1-to-1 risk-reward ratio to get up here, but I have to be aware of the fact that number one, I've got the Bank of Canada coming out, and number two, if the market starts to show weakness at this continuation point, I've got to bail, because that was my objective. I can't expect to have a tight intraday stop and hold on to see what the market's doing. It doesn't work like that. So so you have to understand that your stop loss and the situations that you're trading have to be in line with your objectives, and you have to realize what your objectives are. Okay, if you're trading a short-term intraday pullback, your objective is intraday. End of story. Because once the market starts to get through this continuation point, contrary orders are going to be there. There are going to be traders trying to fade the top, and depending on the situation, we know foreign exchange can go back and forth a lot during the day. So that has to be your first initial target. I mean, you're swing trading. You're getting in on a pullback, and you need to look at the most recent swing high as your initial target. So if this were an hourly chart, so like if you're trying to play this kind of pullback, or if you play this kind of pullback, right, waiting for the market to come back down, show some strength, or at least signs of stalling, that's already different, because your expectation, number one, is to get back up here, and it's going to take half a day to get back up here, right? And putting your stop below here, it gives you essentially a whole day's worth of volatility potentially that you can ride out before actually saying, look, my timing was off. And in here with a stop inside the intraday chop zone, you're much more at risk. So you're going for an intraday target, or an intraday trade management, without a doubt. If your stop had been below the day's low, it's you're saying, I don't really care where I enter, because this is a multi-day trade anyway, but your stop has to be down here so that you can absorb that kind of volatility. So it's kind of important. This is kind of an important point, because it can create a lot of frustration if you're mixing, if your entries aren't in line with your expectations for the entry and your stop loss, right? Because everything has to be in tune. Your entry, your stop loss placement, and your trade management, they all have to be in sync, working towards the same objective. In this case, it had to be intraday, end of story. In this case, it can be multi-day, because you've just got wider parameters. Okay, that's it will be intraday, and it'll be like a day trade in any case, but it can be multi-day, because you've given the market a lot of space to trade and to negotiate. So what's the objective that best suits you? Is it an intraday objective? Is it a day trade? Is it a swing trade? And what are the differences? Well, intraday, you're going to have obviously higher trade frequency. Okay, so you're going to have more opportunities. You're going to have higher turnover, but you have to consider that spreads become more of a concern. And your risk management also becomes essential, because if you're going to be trading so frequently, it is much easier to dig yourself into a hole if you just keep trading and trading and trading, and you keep losing and losing and losing. You can just dig yourself into a big hole in 1 or 2 days and never get out of it. So your risk management and your trade management have to be, really, watertight. Your time availability. If you're trading intraday, you need to have the time to follow the trade. You got to stick there. You got to stay there in front of your screens, because it requires more precision. Now, day trades also give you a decent trade frequency. Okay, there's more limited turnover. And this, by the way, is what I do mostly, is like I have one entry and I'll wait, I'll try to manage it during the day, and see if it will present like a rollover situation where it is pushing strongly into the London close, and I'll try and just leave it until the next day. So you still have a decent trade frequency. You got 3 or 4 trades per week. The turnover is much more limited than intraday, so you have less time commitment, and you can be a bit less precise with your entries. I'm really imprecise in my entries. A lot of times, with this kind of trade, 10, 20 pips doesn't really matter. Of course, the caveat is that 10, 20 pips on the Aussie or the Kiwi does matter. But if it's 10, 20 pips on sterling Aussie or sterling Kiwi, Euro Aussie, Euro Kiwi, then yeah, it doesn't matter. Swing. Yesterday I did a webinar for FCI markets showing a simple swing trading model. Swing, you have very low frequency. You're playing off the daily charts basically. You have limited turnover. You have so you probably need to put a bit higher risk on for each trade. It has a very low time requirement, and you can be fairly imprecise with your entries. So what are the keys? You need to consider your time availability and what suits you the most. I know a lot of people are attracted to the intraday because they say, well, I can get trade after trade after trade, so I can really rake up the profits intraday. That's not the truth. The truth is that yes, you might have more opportunity, but it's useless if you can't, actually exploit those opportunities. And it's the risk reward is such that you have more opportunity, but you also have more opportunity to dig yourself into a hole. So, usually for traders that are trading around a day job, etc., you stick to the lower frequency stuff. You have to, and you also have to work towards, what works for you. So it's like, don't try to trade like me. Don't try to be me. You have to aspire to be the best trader you can be. You have to take what works for you and throw away all the rest. This is a screenshot from one of the traders that I've been trying to help recently, and this is what happens when you try to copy me without really understanding, or without it being suitable for you. You have to do what suits you. You have to take whatever bits and pieces of information are useful from these webinars or from our interactions, but you need to do ultimately what works for you. Okay, and that's one of the reasons why so many people fail at trading, because they're always trying to copy somebody else's recipe. And instead, this is something that's very, very personal, because it has to do with your treasure. It has to do with your own money. And you have to believe, you have to understand, your mind has to understand, and your heart has to believe in the reasons for risking your hard-earned money each and every time you step up to take a swing. If you do, and you have to be at ease with the management, the time that it's going to take, the expectations. You have to be at ease with all of that. So it has to be extremely personal. And you also have to be consistent with what you do. You've got to measure everything you do so that you know what works and you know what needs